A few years ago, I was burning out in a 60-hour-a-week consulting grind, constant calls, stacked deadlines, and zero breathing room. Everything felt like work, even after work. But today, my ETF portfolio has become the part of my life that actually gives me space back. It grows quietly in the background without needing me glued to screens or chasing charts. And in this video, I'm going to walk you through exactly how I built that kind of freedom step by step. Stick around until the end because that's where everything clicks. Here's the part most people never say out loud. ETFs aren't flashy. You're not going to wake up with some dramatic overnight win. There's no hype, no wild swings to brag about. And they're definitely not a shortcut to wealth or some get-rich-quick scheme. What they do is grow money gradually over time, but only if you stay patient, stay disciplined, and stick with the plan, even when it feels boring. It's not effortless, and it's not automatic. You still need to make good decisions, stay consistent, and trust the process through the ups and downs. But that steady long-term approach is what eventually shifted everything for me. Quick disclaimer, I'm not a financial advisor. I'm just sharing my own experience and what's been working for me. Make sure you do your own research before you invest in anything, or consult with a licensed financial advisor before making any investment decisions. Let's dive in. I started my investing journey early in my career, thinking I was on top of the world. My friends were day trading, bragging about their gains in the group chat, posting screenshots of their accounts. Meanwhile, I was researching something called index funds and ETF, and everyone thought I was crazy for not chasing the hype. Fast forward to today, and most of those friends either lost money or barely broke even after years of stress and staring at screens. Me? I'm sitting on a portfolio that has grown steadily after a couple of years, and I couldn't even tell you what the market did last week because I don't need to check anymore. There's a quote I've always liked: wealth is built in whispers, not shouts. That's what ETF investing really is: slow, steady growth that turns into something meaningful when you give it time to compound. Whether you're putting in a small amount consistently or you're already investing more, the ideas I'm about to walk through apply the same way. My name is Jay, and I made this video to simplify everything and share the approach that's helped me understand ETF investing over the years, especially if you're just getting started and want a clear, beginner-friendly breakdown. Before I started investing in ETF, I was what you'd call financially blind. I knew money was coming in from my paycheck, and I knew money was going out for rent, food, and whatever else. But if you'd asked me exactly how much I spent on groceries versus eating out, or how much I was burning on subscriptions I barely used, I wouldn't have had a clue. ETF investing changed that because suddenly I had a reason to care. I wasn't just thinking about today's spending anymore. I was thinking about future wealth. And that shift in perspective hit me like a freight train. I started tracking everything, and I mean everything. I used a simple spreadsheet at first, just logging every single purchase for a month. What I discovered shocked me. I was spending a huge chunk of my income on food delivery. If that money had been invested instead, over time it could have grown into a life-changing sum. I realized I was literally eating away at my future retirement, one order at a time. Then came the subscriptions: Spotify, Netflix, Hulu, a gym membership I barely used, a meditation app I downloaded once and forgot about. I didn't even realize how much was quietly leaving my account each month. You know the real shocker? I wasn't just spending money, I was losing opportunities. Every dollar wasted was a dollar that couldn't grow for my future. And once you truly grasp how compound interest works, you start looking at money in a completely different way. I'm not saying you should never enjoy life. What I am saying is that awareness changes behavior. Once I saw what my spending was actually costing me in future wealth, my choices started shifting on their own. I began meal prepping on Sundays, trimmed my subscriptions down to just 2, stopped buying on impulse, and gave myself a 72-hour rule for any non-essential purchase over $50. And the fun part? My quality of life didn't drop at all. If anything, it improved, because I wasn't carrying that low-level stress of wondering where my money went each month. I was in control. And that felt amazing. After just 3 months of tracking my spending and making conscious choices, I went from investing $200 a month to increasing my monthly contributions. Same salary, same lifestyle. The only difference was being intentional instead of mindlessly spending. Understanding your money isn't about being cheap or depriving yourself. It's about being strategic. It's about choosing that your future self deserves the benefits of compound growth more than your present self needs. Another thing you'll forget about in a week. Let me tell you about one of the toughest financial lessons I ever learned. Back in 2020, during the pandemic, there was a lot of hype around a biotech company working on a potential COVID treatment. The stock was trading very low, and online forums and videos were all saying it could skyrocket if things went well. I put some funds into it. I checked the stock constantly. First thing in the morning, at lunch, before bed. It completely consumed me. When it went up, I felt like a genius. When it dropped, I felt sick to my stomach. 6 months later, the Food and Drug Administration didn't approve the drug, and the stock plummeted. I sold in a panic and ended up with much less than I put in. I lost a lot of money, but more than that, I lost 6 months of sleep and peace of mind. But that wasn't even the worst of it. Earlier on, I put some money into what I thought was a hot tip from a coworker about a renewable energy company. That stock ended up getting delisted for accounting issues, and I lost everything I'd invested. I also tried options trading for a few months. I watched every YouTube video on strategies, learned about calls, puts, and theta decay, the whole thing. I thought I was being smart and sophisticated, but I ended up losing a significant amount before finally admitting I had no idea what I was doing. That's when I started actually educating myself instead of just watching hype videos and following tips. And what I discovered changed everything. I learned that roughly 85 to 90% of actively managed funds don't beat the S&P 500 over a 10-year period. Think about that. These are professional fund managers with teams of analysts, Bloomberg terminals, direct access to executives, decades of experience. And they still can't consistently outperform a simple index fund that owns the 500 largest companies in the US. If the pros with all those resources can't do it, what chance did I have? I was a consultant trying to pick winners in industries I barely understood. Going up against hedge funds running algorithms that execute trades in microseconds, I was playing a game I couldn't win. And the beautiful part, I didn't have to play that game at all. I remember the moment it finally clicked for me. I was sitting in my apartment looking at my brokerage account, seeing all these individual stocks I'd bought. Well, half of them down significantly, and I asked myself, what am I doing? Why am I trying to outsmart the market when I could just own the market? That weekend, I exited most of my positions, keeping only a few winners with capital gains. I took some spare money and spread it across 3 ETF, one tracking the S&P 500, one focused on international markets, and one covering US small cap companies. That was a few years ago. Since then, I've kept adding to those same ETFs consistently, every single month. The best part? I haven't lost a single night of sleep over it. I don't stress about market swings. I just stay consistent. ETF investing didn't just improve my returns, it completely changed my relationship with investing. What used to feel like stressful speculation became steady, boring wealth building. And boring is exactly what you want. This is the part where the whole approach finally made sense. Here's something that nobody talks about. Complexity costs money. And I don't just mean fees, though we'll get to that. I mean the mental energy, the time, the emotional bandwidth that gets drained when you're trying to manage a complicated portfolio. Before ETF, I had 9 individual stock positions. I had a spreadsheet where I tracked each one when I bought it, what price, and what my thesis was for buying it. I had price alerts set up. I was subscribed to earning call notifications. I spent probably 10 to 15 hours every week just trying to stay on top of everything. And here's the kicker. I wasn't even good at it. But even when I made money on a stock, I had no idea when to sell. Do I take profits at 20% gain? Do I let it ride? What if it keeps going up and I miss out? What if it crashes tomorrow? I remember putting $1,000 into shares of a cloud computing company at $32 a share. It jumped to $58 in about 4 months. I was up over 80%. Everyone told me to sell and lock in profits. But then I read an analysis saying it could hit $100, so I held. 2 months later, it was back down to 35. I finally exited at $38 for a measly 18% gain when I could have made 81%. That's the problem with individual stocks. The hard part isn't buying them. Any beginner can look at a hot stock and buy it. The hard part is knowing what to do with it afterwards, and that requires constant attention and decision making. ETFs solve that problem completely. One of my portfolios has just 3 ETF, an S&P 500 fund, a global stock market fund, and a small cap value fund. Between them, I'm invested in more than 7,000 companies across the globe, and it's completely hands-off. I own pieces of Apple, Microsoft, Amazon, and Google. But I'm not just limited to big tech. I also get exposure to companies in manufacturing, banking tech startups, pharmaceuticals, and markets across Europe and other international regions. And the best part? All that diversification comes from just 3 ETF. Here's what makes ETFs so powerful. They manage themselves. If a stock falls, it naturally becomes a smaller part of the fund. If a company fails, it gets swapped out. The fund does the heavy lifting. Today, my whole investing routine takes under an hour each month, and half of that is just confirming my automatic investments went through. I'm not picking stocks, watching reports, or timing trades. I simply keep buying the same 3 ETF, month after month. Let's talk about fees for a second. This is a big deal. When I was buying individual stocks, I didn't pay management fees, but every trade had a commission. Even at just a few bucks a trade, all my buying and selling probably cost me a few $100s a year. But the bigger hidden cost was the spread, the difference between the price someone's willing to sell for and what you're willing to pay. Especially with smaller, less liquid stocks. That adds up. I did the math once, and I was probably losing around 0.5% to 1% of my portfolio every year just to market mechanics. With my ETF portfolio, the total expense ratio across all 3 funds is only about 0.08%. That's 0.08%. On a portfolio of my size, it works out to just a small amount each year. No trading commissions, no hidden spreads, nothing sneaky going on in the background. To put that into perspective, the average actively managed mutual fund charges about 1% a year. It doesn't sound huge at first, but over 30 years, that 1% can reduce the final value of the portfolio by roughly a quarter. It's not just the fee, it's the compounding you lose along the way. But it's more than just the cost. There's a mental price too. When I used to juggle 9 individual stocks, I was constantly on edge. Did I miss some news? Should I sell? Should I buy more? It felt like homework every single day, and it was draining. But now I could go on vacation for a month and not touch my portfolio once, and I'd be perfectly fine. That's exactly what I did last summer. 3 weeks in Europe, I didn't check a thing, and when I got back, my portfolio had gone up about a bit. That kind of peace of mind is priceless. There's a concept in productivity called decision fatigue. Every choice you make during the day drains your mental energy. By cutting my investments down to just 3 ETF, I freed up a ton of mental space for things that actually matter. I'm not stressing over whether Tesla is overpriced, or if I should sell a pharmaceutical stock. That energy goes into my career, my relationships, my hobbies. The complexity tax is real, and most investors pay it without even noticing. ETF lets you skip that tax entirely. Now let me give you the exact step-by-step blueprint I wish someone had given me when I started. This is the optimal order of operations, and if you follow this sequence, you'll avoid the mistakes I made and set yourself up for long-term success. Before you invest a single dollar, you need to understand that building wealth is a marathon, not a sprint. You're not going to get rich next month. But if you start today and stay consistent, you will build real wealth over time. The key is to start thinking like an investor instead of a consumer. Every dollar is a choice between instant gratification and future wealth. Before you invest a single cent, you need to have at least a small emergency fund. Why is this important before investing? Because life happens. Your car might need repairs. Your laptop could crash. A surprise bill could show up. Without that cash buffer, you'd have to either sell your investments at the wrong time or rely on credit cards. That first funds acts as your starter safety net. Here's what most people don't understand about building wealth through ETF. It's not about timing the market. It's not about picking the perfect fund. And it's not about making some genius move that nobody else thought of. It's about consistency. It's about investing month after month, year after year, regardless of what the market is doing. In 2022, the market was down about 20%. I kept investing. In 2023, the market was up about 25%. I kept investing. When experts on TV were screaming that the sky was falling, I kept investing. When my friends were bragging about their crypto gains, I kept investing in index funds and ETF. That's the formula. There is no secret. Just consistency, low-cost diversified ETF, and time. That's it. If you're new to ETF investing, just start simple. You don't need to chase every hot fund or memorize ticker symbols. Begin with 1 or 2 solid, diversified ETF, learn how they work, and build from there. The goal isn't to get rich overnight. It's to understand the system you're investing in and let compound do its job. ETF investing changed my life not by making me rich overnight, but by giving me a clear, simple, proven path to build wealth over time. It gave me financial clarity, it eliminated the stress of trying to pick stocks, and most importantly, it gave me freedom to live life on my terms. Follow this approach, and it can work for you too. This isn't financial advice or a recommendation, just sharing what's personally worked for me and what might help you think differently about investing. And if you're still deciding where to actually invest, whether it's Schwab, Fidelity, or Vanguard, I tested all 3 broker platforms myself. You can check out that video right here to see which one stood out. I will see you there.